Outlook Business Investment Summit 2021 is brought to you by ICICIdirect.com. Welcome to Outlook Business Investment Summit 2021. In this segment, we are presenting to you a stock idea by an accomplished value investor, ArunaGiri N. He's the founder and CEO of TrustLine Holdings, which runs a PMS. Their value fund has compounded at the rate in excess of 20% since 2007. First, ArunaGiri will present his investment case, after which we will take some questions. Thank you.
Hi, and thanks a lot for having me on this show. It's my pleasure to be here. My best trick, which I'm going to be talking about, is entertainment network. And if you look at the market today, there are very, very few opportunities which can give you deep value because markets have rallied and a lot of small mid-caps have got re-rated in the last 1 year. So it's very difficult to identify any script which can be which can give you a deep kind of opportunities. And we find entertainment network as one deep value. There's a reason why we see this as a deep value opportunity is because there's a huge disconnect between what market perceives this as an opportunity and what is the underlying reality. If you look at it, market perceives this as a pure play radio opportunity. Whereas there's a huge transformation underway in terms of changing the business from a pure play radio to a digital ad solution company. As for management, they are looking at increasing the revenue share from digital ad solution from currently maybe about 10-11% to close to about 50% in next 3-4 years. That's going to be a real game changer for the opportunity. And because of this disconnect, you're getting this at a very, very deep discount. And if you look at since market perceives this as a pure play radio, and which is not looking at in terms of the digital transformation, one is looking at currently the opportunity at almost at a 15% kind of a free cash flow yield. So that is one thing. And in terms of digital transformation, the opportunity is very, very big. If you look at digital ad solution, this is a big market for anyone. But currently, it's a very fragmented market with many, many players. And there's a huge opportunity because if you look at digital ads, it's almost now 40% of the overall ad pie. So if you look at the overall market size of $10 billion, almost close to $4 billion is going to be digital marketing. And if anybody can really build a story in that, there's a huge opportunity waiting for somebody to tap it. And ENIL probably understood this much ahead of everyone else in the competition. Almost 3-4 years back, they started building this digital ad solution team. They foresaw that the radio business, the moat in radio business is going to be declining. And they foresaw this about 3-4 years back and started building this digital ad solution. So they have senior hires and they have a huge content team, almost close to about 300 creative people in the content team, which can create contents for the digital ads. And they have a huge captive multimedia platforms, which they can offer for as part of their digital ad solution. So be it their own MX Prior, which has got a huge subscriber base of 175 million, or Takatik short video platforms, or their own YouTube subscriptions, which runs into 11 million subscribers. So if you look at all these, I think they have, when you go to an enterprise, you can offer digital ad solutions across multiple platforms, in addition to their legacy traditional media, which is radio and print. So they have a good story which they are building. If they execute it well, I think in the next 3-4 years, they can really build this into a large business, which can be around 40-50% of their overall revenue. In addition, radio business also is going to be, though it gives you a lot of value because currently it's going through challenges because of, yield in terms of their ad revenues. And though the ad volumes have recovered to almost pre-COVID levels in Q3, the realization is, quite low compared to what it used to be. So as a result, the revenues are still falling. But we foresee this yield to improve to pre-COVID levels in next 2-3 quarters. So as a result, radio business will come back to pre-COVID and it will normalize. And the growth will come from digital business, which will give you the higher margins and higher earnings. And then that's where I think we feel the overall intrinsic value of this particular opportunity is closer to about, I would say about 3 to 4 times the current market value. And it's one of the very, very deep value opportunities. The reason being, there's, even if you look at the cash holdings in the balance sheet, it's almost 35% of their market cap. In addition to that, if you look at net of cash, I think in terms of what they can generate as free cash flow in the coming years when the business normalizes, it's almost close to about 120 to 1.2 to 1.5 billion rupees, which they can generate as free cash flow, which means you're looking at closer to 15 to 20% of FCF yield, even if you look at 1 year down the line. So it's a fantastic opportunity. It's a growth come discount, growth come value kind of a play. Value comes from radio business. Growth comes from their digital transformation. So it's a real deep value opportunity which can offer a fantastic upside for any patient investors. Of course, it's going to take a longer time. It's not going to happen overnight. Digital transformation will take at least 2-3 years to really come to the surface, which means one needs to have patience. But the current valuation, it's more like a heads you win, tails you don't lose kind of an opportunity because it's so distressed kind of valuation where the downside is limited. But if the story goes well in digital transformation, if they execute well their strategy, then you're looking at 3 to 4x kind of an upside on this opportunity.
Thanks so much, ArunaGiri. The first question I want to ask really is, last year was obviously a down year for radio in terms of ad revenues, so financials suffered. And most analysts have been expecting that this year will be much better. At least till 2-3 weeks ago, there was great level of optimism about how this will be a comeback year, and also because of the base effect, etc. But in 3 weeks, the sentiment has changed quite considerably. And definitely for media, surely it's the same thing. So how do you see this year's financials and spends panning out for ENIL? And what kind of valuations are we talking about?
You're right. I think, of course, people expected, I think the management expected by Q1 or Q2 of FY22, the yield would move back to pre-COVID levels. And though the volumes have recovered largely to the pre-COVID levels, yield was much lower in last quarter, but they expected this to correct and come back by Q2 or, by FY22. Now it's going to be delayed, of course, because of COVID second wave. But our own estimate is, yes, suppose even if it is going to be delayed, it's not going to be delayed. I think this is slightly got delayed, so probably you will see this recovery in yield being pushed back to Q3 or Q4. So to that extent, it is a challenge. But the story is not gone away. Radio will still be a significant part of ad pie. It will continue to enjoy that 4 to 5% spend of the ad. And that way, I don't think. And the other interesting thing is during lockdowns, the listenership is going up for radio. Though listenership is going up, as a fallout, your yield should go up, ad revenues and our ad volume should go up. But that is, not immediately moving up because of less demand because of lockdown. But once the situation normalizes, one would find this radio getting its due space of that 4 to 5% in the ad pie. So we don't have any much of challenge in terms of getting back those pre-COVID levels, but it got delayed. You're right.
Sure. Tell me, overall, this story, I mean, how do you see 5 years down the line, the character of this business or the revenue profile of this company really changing? Do you see radio still as a growing pie, or do you see it as a diminishing pie over the next 5 years?
Yeah, so that's a very interesting question, Maha. Actually, if you look at it, radio will continue to grow, but not at it will be much lower on low single digit kind of growth is what one can expect in radio. So it's not going to really drive growth for the company, right? This company realized this much earlier. 3 years back, they realized that radio is going to be facing headwinds. It will continue to grow, it will have relevance, but unlikely that it will grow that supernormal growth which it did 3-4 years back. So as a result, the company took steps to change its overall underlying business towards digital ad. And if you look at digital ad business, a very, very interesting story. As I said earlier, it is a very fragmented industry, and it's growing at a hyper speed. And when it started growing, the incumbent players like traditionally the ad agencies, failed to exploit, to capture their market, because it was initially led by technology companies, because the requirement for SEO as well as analytics or apps, that requirement was so high that technology companies took the lead. But there was a drawback there. The technology companies could give only technology and analytics and apps, but not the content. So what happened was the companies which wanted to have presence in digital space, they had to develop their own content team. So it became a hybrid model where the technology companies gave this analytics and the digital presence, and the companies developed their own content. So that is why the market is so fragmented and there are no large players. The best player has got only about 300 people. So that's the largest player. So there is an opportunity there for someone who can give leadership in both content and technology. That's where ENIL comes. Now for content, I think you need creative team, and you need to have social, multimedia presence. You need to also have captive digital media where you got your own followers. And so that's where ENIL has got a leading edge, which other radio players may not have an edge. And as I said earlier, ENIL has got its own MX kind of OTT platform. It has got its own content team, which runs to about 300 people, and they're expanding. And they have recently hired senior team to lead this digital transformation. Plus, they also have an on-ground coverage. They do a lot of events which are based on Mirchi on-ground shows, Mirchi, Bollywood kind of shows. So they have online on-ground presence. So overall, when they go to an enterprise, they can give a very, very comprehensive solution, which is your traditional media, on-ground presence, and the digital OTT and original content, which no one else has got a kind of an offering currently in this market, be it ad agencies or technology companies. Which is where I think you have somebody like Prashant Pandey, who's leading from the front, and he has a very visionary leadership, and he's driving this very passionately. So if this gets executed with this kind of drive and passion, I think 3-4 years, we have no doubts that the business profile will change completely towards digital ad solutions, which will constitute almost 40 to 50% of their business from the current 10-11%. And believe it or not, digital ad solutions are high margin business. It runs at much higher operating margin, closer to 25% kind of level compared to your traditional business. So as the revenue profile changes towards digital transformation, the margins will increase, and regular free cash flow would continue to flow from radio business. That's a brilliant part of it. Your value comes from radio, and growth comes from digital, and that makes the whole story very interesting.
So I agree to this point that, in the initial days of this, the digital ad universe, there have been all kinds of players, the ad players trying to get a piece of action by outsourcing the tech part, the tech guys doing it without having expertise in content and so on. But with respect to ENIL itself, it's part of a group which itself has entrenched interests in media across, all segments. They have their own advertising agency, they have traditional media, they have presence in. So pretty much everybody in the group is doing everything and trying to offer integrated solutions. So now this is a public company, and there are much bigger private companies within the group. So why should we believe that this company in its own group will be nurtured and valued and will make the transition and take the big leap, while the rest of the company, which is also trying to do integrated strategy, is a larger part of the business and it remains private?
Correct. I think that's a serious challenge. But I think we got to go by what the company has been doing so far, and that is, if you go by that evidence, I think there is a serious focus from the current management in terms of transitioning this business from radio to digital ad solution. So one is they've changed their brand. Earlier it used to be Radio Mirchi. Now radio has been taken off. It's now rebranded as Mirchi, and there's going to be a lot of money and focus which is going to back up this particular new brand, which is Mirchi. So that tells you that the group is behind this kind of new initiative. The other thing comes from the leadership from Prashant Pandey. I think I had the one-to-one discussion with him, and we had seen his kind of passion in terms of driving this business and changing this revenue profile. And that's where our confidence comes that this is a serious thing for ENIL. And they've also realized that radio is not going to take them far. And it might give them value, it might give them free cash flow, but it's a business which is going to grow at a low single digit. So the real growth for ENIL has to come from the new digital business. And they have a story there, and they have increased. If you look at last 3 years, the number of digital customers have gone up threefold, and it is still growing. And their kind of credentials they have built in terms of many ad campaigns, which you can see from their investor presentation. There are who's who in terms of pharmaceuticals as well as FMCG, consumer goods companies, where they have really offered integrated solution for their campaigns. And it has worked, and we foresee that this is going to continue. And digital market is much larger business. Everybody has a share. Even if you move up, from current 11%, which is you're talking about 40-50 crores in their revenue share of $4 billion the market size. So there is a huge headroom for somebody who's a focused player, and for the size which we're talking about, a company with a market cap of just about 680 crores, there's a lot of things which can be done here. The other thing is, I think in terms of valuation, ENIL, in spite of being a leader in radio, in spite of doing this digital transformation, peer-to-peer comparison, if you look at relatively, it's going cheap compared to even its nearest competitor, which is music broadcast. That's trading at 1.3 times a book, whereas your ENIL is trading at much below book. So this market disconnect is it's amusing, but that's where value comes for somebody who can patiently be invested in this kind of opportunities.
So what kind of revenue and what kind of earnings and free cash flow growth are you looking at over the next 3 to 5 years overall?
I think
low single digit radio growth means it has to be offset by very significant ramp up in revenues on the digital side for you to even get a 15-20% earnings or fee.
That's true. But if you take FY20 as a base year, you can project a much higher growth. So that's not obviously, because FY20 was a very, very low base, so that cannot be a reference. So if you take
right now, what is the revenue and earnings composition in terms of business?
In terms of business, I think their normal years they used to do about 500, 550 crores, which was FY19, 18, and all that. But FY20 was a year in which they lost a lot of business, so they finally ended up FY20 at probably FY21 FY21 December TTM basis. If you look at this, will be around 324 crores. So they have for overall, I think it is 10% digital, the rest is radio and.
Okay.
So rest is radio, but they also do a lot of on-ground event management. So if you look at radio alone, that will be around 70%. 20% will be on-ground media, on-ground campaigns, and probably 10-11% will be digital.
Sure.
So the way we expect is, you may not have a very huge growth in terms of top line, Maha. Actually, what would happen is top line would continue to grow. Of course, helped by digital, it would probably grow on a mid double digit, but the real action would be on the EBITDA and the bottom line, because the revenue profile, even though it is changing from radio to digital transformation, currently if you look at 30% comes from non-FCT. Non-FCT is basically your on-ground event management, and that constitutes almost 20% and 10% from digital. Now that on-ground business is a very, very low margin event management business. They focus on that, and they increase the focus on digital. So overall, when we say non-radio is going to constitute 50% in 3-4 years, in that 50%, bulk of it will be digital. So what you will see is the margin profile changing dramatically. So margins, you can, probably if you look at the bottom line, the growth will be much ahead of 25-30% in terms of earnings growth for the next 3-4 years. But top line, one has to be really conservative. One will not see major change, but still it will continue to grow much higher than their radio players.
Sure.
That's a way we foresee it.
Sure. Tell me, right now, radio is really a regulated business, in the sense it's a licensed business, so you have significant market share, and ENIL obviously has the opportunity to consolidate its market share further because of how competitors are in terms Reliance is a weak player and so on. But the digital ad market is not like that. It's highly fragmented with very small players, and they're all competing fiercely in this space. So how does that market, and going forward, there is great pressure on all media companies to really capitalize and squeeze that market. So there is obviously the risk of undercutting and realizations falling, pricing, and also the other problem with digital. I should not call it a problem, because for advertisers, it's a great thing. There is very high level of measurability. So, which also spoils the party for a lot of media players when you go out to sell.
So it becomes more outcome based.
It's more and more outcome based. So, given these two factors, do you see? I mean, you already said you have to be conservative about revenue. Do we have to be a little circumspect about what kind of growth that can really begin? Because the nature of the entire industry, media industry, is changing, and everybody is going to be going after this pie exactly in the manner that they are trying to do.
Yeah, that's a challenge. It's a fragmented industry. So to that extent, you can look at it as a negative, you can look at it from one way, it is negative, but the other side is it also offers somebody, a big opportunity for somebody who's a very focused player. So to that extent, I think, but more important aspect of this entire story is ENIL is little ahead of everyone else. They took this initiative 3-4 years ahead. It takes a long time to build a team, content team, and then experiment, and then finally come back with a very credible solution to an enterprise in terms of integrated offering. So it takes a long time. Even if competition decides today and they want to enter, it's going to take 3-4 years. So that kind of an edge is, ENIL has got. So to that extent, they have kind of an edge, so that will be favorable for them. But at the same time, you are right, it's a very fragmented industry and a lot of competition from various sides. And they are very focused on few verticals, which is what I feel ENIL would do. They will not go to all the enterprise in every space. Probably they limit themselves to more consumer-oriented goods, which in itself is very large, and they will spend a lot of money in digital. And if you're focused in a particular vertical and give this integrated offering with their own captive media, which many of the competition doesn't have. If you look at MX Player, 175 million kind of subscription, not many would have a captive social media or OTT platform on which they can offer their ad solution. They have to rely on third-party OTT kind of solutions, whereas these guys have got a captive.
But ArunaGiri, that can be bought. Any solutions company, any ad solutions company can go out and buy media. It's as easy as that today.
That's true.
So the value that an integrated player or somebody who has a foot in all the media is really not a challenge for a new entrant, because it's available for a price.
That's right. And they are using technology, you can be there everywhere. So that's true. But when you have a captive, you have a pricing advantage, right? So you can price and mix in, you have all those flexibilities in terms of giving, arriving at your pricing for the overall offering. Whereas competition would find it difficult in terms of matching your overall competitive price. So that gives an edge. That is at the same time, of course, you need to have, most important part of this is the content, rightly you said. And that's where the company has been focusing, and that's where the differentiation would play. And if they get the content right in terms of team, in terms of original content, in terms of delivering the short videos for ad campaigns, I think probably they will have an edge, because they started this journey 3-4 years back.
Sure.
Yeah.
In your mind, what do you think is the biggest risk?
The biggest risk, I think, what we see is execution, right? This particular journey, I think Mr. Prashant Pandey started about 3 years back, and it's going slow. And they haven't dramatically changed their composition of revenues. It is still about 11% of their total revenue.
Right.
Now we are assuming that it's going to go to 50% in 3 years. How far that is credible, whether they will be executing it, if that doesn't happen, then the whole story falls flat.
Right.
So that, in my view, is the biggest risk that one has to really closely track whether these guys are able to execute and bring this revenue share. And only thing which I would like to emphasize is heads you win, tails you don't lose. That's the biggest secret of this opportunity, because the valuation is dirt cheap. that you're not going to, there is no downside. There's a major downside support. There's a lot of cushion. There's a lot of margin of safety. But even if it works, half of what we estimate, still you get to make a big upside in this opportunity.
Why do you say you don't lose? Because going by how the market has been valuing all these stocks in transition or value stocks, whether you look at NTPC or ITC or any of these companies, you know that the market can continue to derate these companies for a long time.
Yeah.
And so even if you're available at a very attractive price to next year, it could be even more attractive because the market perception doesn't change quickly enough.
Yeah.
So,
I understand where you're coming from. Basically, if you look at basically, as I said, the value comes from radio, growth comes from digital transformation. For a minute, let's assume that digital transformation is, probably is not going to work and the execution goes wrong and you're not going to get those, big margin upside from the digital. Let's assume only radio is going to survive and digital is not going to add big time. Even then, when the radio cycle, ad cycle normalizes in 1 year's time, you are looking at a free cash flow of almost about 120 crores or to 150 crores. And radio is not going to go anywhere. It will still grow, but low single digit, and it will still throw a lot of cash flows. And radio has got its relevance, as we said often, that the listenership is there and it is going to get that 4 to 5% of the pie. So even if this story on digital doesn't work, because of the free cash flow support, because of the cash, balance sheet, what the balance sheet holds in terms of cash, and the earnings are going to come back. And if you look at the pricing, even the worst of the times in March 2020, when there was a big market crash in small and mid caps, the stock price didn't move much below 140. So which means you are trading at a very close price point, which is close to all-time low. So to that extent, there is a decent downside support in this opportunity. Of course, anything could happen. No one can be sure about, 100% sure about anything in this market. But I think if you assign probability, I think there is less than 10% probability that there will be much more downside in this. But there is a 90% probability that you will make at least 2x to 3x upside in over a period of 3-4 years. Not immediately, over a period of 3-4 years. That's very, very critical.
One final question. What will you be watching out for in this stock over the next few quarters?
I think the key thing which we'll watch out is the revenue profile change in the new business which is going to come from digital transformation. What kind of clients they add in terms of their digital ad solution? What is the percentage change over a period of time? Are they really executing what they say? So every con call which what we are going to do in terms of their earnings, in terms of their business updates, are they executing and are they going to on track in terms of getting more traction in digital ad solution? That's the key thing to watch out for, and that's what tells you, and that's a story we have invested for.
Sure. Thank you so much, ArunaGiri. It sounds like a very interesting stock, the whole idea of value plus growth at a time when, especially in today's times when value is not performing and growth is overpriced. For all our viewers, this is not really a recommendation to buy, but it is just an investment analysis, and he's done a thorough analysis, and we've tried to present the risks associated with this stock. Please do your own research and go through the numbers before you take a call on the stock. Thank you so much, ArunaGiri. Thank you for today's discussion.
Thanks a lot. It's a pleasure. It was a great opportunity to talk to you. Thanks a lot.